Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week on the podcast, I have a chance to talk once more to Peter Spiller, who is the manager of the Capital Gearing Trust and has the distinction of being the longest service investment trust manager in the UK investment trust universe. Been doing this since 1982, give or take, so that's a more than 40-year stint. So in that time, Peter, you've seen many things come and go. You've seen many chancellors of the Exchequer come and go, and you've seen many investment trusts come and go. And indeed, in the same token, a lot of trusts today that didn't exist back then. But there are some survivors, and we might talk about that in a moment. So I thought I'd start by just asking you, you had an investor day, which I was able to attend, and you talked a little bit about the history of the investment trust sector in the time that you've been involved in it. And I guess one of the messages you were trying to give was that, in a sense, there really is nothing new under the sun in terms of investment trusts. Some things change, but others don't. And the fact that we're now talking all the time about discounts is not a new phenomenon.
No, that's absolutely right. Discounts are in fact much lower than when I first became involved, which was a little over 10 years before I started running the trusts over 50 years ago. And back then, the background was very much one where the narrative at any rate was that institutions had outsourced management part of their fund management offering to investment trusts, particularly in overseas markets, but that they had, in the more recent times, developed their own capability of running overseas money in particular, and therefore they were selling the trusts to bring it all in-house. So back then, trusts typically traded in the 30s discount. There was one particularly egregious group where the corporate governance was actually criminal, and they traded in the 40s, but were of no attraction.
Right, and there were a number of reasons of that. It was still a pretty cosy world in the city, I think it's fair to say, at that time. And there was some, putting your mates on the board and all that kind of stuff was quite common, I think. But those discounts did, in the course of the 80s and moving into the 90s, they did attract some activity, shall we say. We saw the disappearance of a trust called the Globe, and also we had the arrival of Mr. Robert Maxwell got involved at one point. So there was a sort of precedent for Saba capital of sorts, somebody coming in and trying to close a discount by force, so to speak. But it wasn't that common, was it?
No. So the examples you speak of were essentially companies trying to make rights issues. So they would do a share bid, and that would raise a lot of assets they could turn into cash very shortly. So effectively, it's kind of rights issue. Things changed dramatically in 2000 because as this century began, it became for the first time possible to buy in stock and issue it very easily. And as a result of that, since then, discounts have always been voluntary in the sense that the boards could always have closed them if you did to begin with.
I was going to ask you about that because you say that, and of course you're right in a sort of narrow sense that discounts could be eliminated by all investment trusts if they took the right responsive action. But in practice, it's not quite as easy as that, is it? Just for example, if you have an infrastructure trust, to take a topic example, and you're marking it to model, nobody actually can be certain what the discount is. And even an honest board can take a stab at it, or at least get their advisors to take a stab at it, but they don't know for sure. So it's not totally surprising that you might see discounts in that sort of case. And indeed, we have normally seen most investment trusts trading at a discount. So either that means in your world the market isn't doing enough to resolve it, or there is some degree of involuntariness about it.
Well, of course, my remarks were entirely addressed at trusts with liquid underlying assets with a market price. The apparent discount to NAVs that prevail among the alternatives are, of course, very different from that. For a start, the underlying assets are liquid. And for another thing, some of the asset values themselves are not even an attempt, so it seems, to represent what the assets could be sold for. I'm thinking particularly of renewable energy trust, where the valuables come up with numbers for what are essentially operating companies in large part, with many variables. There are interruptions to production schedules, there's hugely changing prices, volatile prices, And essentially, as I say, they're operating companies. So that's cited out whether in the case of them, it's proper to speak of an NAV at all. Indeed, the chairman of Aquila European Renewables, in his last statement, distinguished between the NAV that the valuers had come up with, the model NAV, which is what they declare, and the actual achievable NAV when all these assets are for sale, which they are in that case, which is much lower.
Okay, so we'll come back to the infrastructure and renewables in just a second, but I just want to follow on from one point that you said there. So at the moment, I think on average, even if we look at just the liquid equity trusts only, the average discount is somewhere between sort of 8-9%, I think, in most cases. And we know that the investment trust sector has been shrinking for a whole variety of reasons, and we've been chronicling that for the last 3 years. Does that imply that the investment trust sector is going to continue to shrink? I mean, the AIC has lost about a quarter of its members. So is there more to come?
Well, in terms of numbers of trusts, I believe there is a lot more to come, because there are still over 200 by our rough estimation trusts which need to do something to achieve viability. So that would be merge or open end or go to a discount control model. But I think if board members are proactive, then we can end up with an investment trust movement as a whole that is bigger. That's to say, we will end up with far fewer but much larger funds run by managers that people want to have in charge of their money in areas that they want to be in. So rather like open-ended funds, they will fluctuate if they have a good structure in size themselves, but they will fluctuate around a growing trend.
And that will be a permanent change?
I think so, yes, because to do that, you need to have something like a discount control mechanism, like the one which capital gearing has.
Indeed, and help to pioneer, of course, yeah.
And we've seen both big increases and redemptions, and either is fine. Both have contributed to asset value improvements. And it does mean that only those people who actually want their money run by that particular trust had it run by them.
So what conclusion do you draw, for example, from the decision by the board of Smithson, Terry Smith's sort of Global Smaller Companies Trust, effectively to give up the ghost as an investment trust and become an open-ended fund? They bought back an awful lot of shares. So what you're saying is that this is just a Darwinian process. There isn't enough demand for that particular trust or that particular style of investing, perhaps, and we should say goodbye to that trust. It has no future as an investment trust.
Well, we do have some history with Smithson, actually, because a couple of years ago, they proposed to withdraw a continuation note. We did not necessarily want to discontinue, but we made a big fuss about withdrawing it, because you cannot take away rights from shareholders in that manner. And to be fair to them, they were very responsive and reinstated it, and it was passed. But they committed to a particular level of discount. And as you say, they spent a great deal of money to achieve that discount. Didn't quite manage it, because unfortunately, the area that they were in was in a bear market, essentially. Certainly compared with equities generally, and so the performance was really very poor. They bought back a lot, but not enough to make supply equal demand, i.e. to stabilize the discount at the levels that they committed to. So I was surprised when they took a decision to convert to an open-ended fund. But I think it's a perfectly responsible and satisfactory thing for them to do.
It is a trust where we know that Saba Capital have taken a significant stake. I think they're up to about 16% now. Would it be your assessment that maybe they would have hung around if they hadn't had such a vocal and critical investor on their share register? I'm trying to think what the sort of moral of this story is, really. What is the moral of this particular episode?
So the only moral in any story in investment trust that is successful is that shareholders have been looked after by their directors. But the influence of Saba has been really quite profound. So where they have taken stakes, obviously trusts have reacted to that. But I think more widely, plenty of boards of directors have taken very good action to make sure their discount is not wide enough to attract Saba. Saba hasn't always been a positive influence on the outcomes of the particular trusts where it has been to be, where it has built up stakes. So there was initially an attempt to capture the trusts and have the money run by Saba, which would have been most unfortunate in my view had they succeeded, and the city really came together to stop that from happening. But more recently, there's been a couple of Baillie Gifford trusts where Baillie Gifford have proposed a merger with a substantial buyback, which appears to have been limited to Saba to take them out, which would have meant that the subsequent trusts that emerged from that would have had a very high weighting in private assets, which they're probably perfectly good private assets. But for good or ill, the market does not place much faith in that. And all investment trusts with significant private asset holdings tend to trade at a large discount.
Yeah, I mean, I perfectly understand. I mean, we can talk in a moment about the TRIG-HICL merger that no longer is. But in the case of the Baillie Gifford Trust, you've got two trusts. They're both managed by the same manager. That's similar to HICL and TRIG. And they're proposing putting the two together to create something which I think your argument in the case of TRIG and HICL, we'll come back to that, was, well, they're putting together two things that shareholders could actually buy themselves if they wanted to. They're both reasonably sizable trusts, the Baillie Gifford ones, USA and Edinburgh Worldwide. So does the actual deal make any sense, or would the deal have made any sense even if Saba hadn't been there? Do you think it would be a positive step by them to combine the two? They will be offering a cash exit to 40% of the shareholders in one of those trusts. But obviously, Saba already accounts for a big chunk of that. What I'm saying is it a sensible move by the Baillie Gifford board to try that merger?
Well, I think it has the very significant drawback that the percentage in private assets,
Right,
the resulting vehicle, would have been much greater. I'm pretty sure that would have implied a much wider discount. So I'm fully sympathetic to the board. What on earth do you do? But for me, the key point is that Saba are not favoured at the expense of other shareholders.
Indeed. And it's very important that boards of directors should not, if you like, discriminate in favour of one large and noisy shareholder at the expense of others.
Right. I mean, that is their plain duty, is to look after all shareholders. So often Saba put on or nominate board members, or more frequently try to. And I would just point out, there's been some more pointed today, I think, that it is the duty of those new directors to look after all shareholders equally, and definitely not a duty to be there to argue for Saba's realization of its shares if other shareholders are left in the lurch, so to speak.
Would you be willing to offer an estimate of how this one will play out? I mean, Saba's come out with its proposal. It's December. It's just coming up to Christmas, same as last year. They seem to be flexing their muscles at this time of year again, with perhaps an idea of causing maximum mischief, if you call it, or maximum hassle for the boards. What would you think would actually happen in the case of the Baillie Gifford proposal?
Jonathan, I really don't feel I'm close enough to comment on that. I have no idea how it will play out. And I should just say that I'd be saying rather negative about Saba, but there's no doubt that the existence of Saba has had a positive effect for shareholders in this trust, because it has supported those directors who want to do the right thing, so to speak, to argue for it more vigorously, and those who are opposed to it to argue less vigorously.
Finally, on this particular point, I mean, Saba has accumulated a stake of around 25-30% in a few trusts and tried to use that as leverage to get the result that they want, which would originally, as you say, was to take on the running of the funds themselves, which shareholders rejected. We have well-honed takeover rules and so on. Do you think that the rules are fit for purpose to protect shareholders generally from minority shareholders just below the threshold where they have to make an offer for the whole company?
Well, actually, I do think the rules are adequate. I don't think it's a regulatory problem, but it does require sometimes some quite courageous decisions by directors to defend actually the majority shareholders, because typically some have only a minority. In all cases, they have a minority. But nevertheless, obviously, when it comes to votes, there's every chance that they can succeed in votes. The directors have to be very aware of the dangers and to take actions to make sure that nothing which is invidious to the position of individual shareholders happens.
Indeed. So one thing we've seen happen in the last 3 years, we've seen more boards adopting or being persuaded to adopt the principle of having continuation votes, regular periods. We've seen more boards adopting redemption opportunities or performance-related tenders and so on. And we've all seen a lot of share buybacks. So there's a lot of things going on. Do you have any particular thoughts as to which method? Obviously, it vary a lot from one company to another, but is there essentially a kind of ideal package that a board should put together? In other words, is it sensible to take it to extreme and have a 1-year redemption opportunity, which a couple of boards have done and they found that rather painful? Or is it something that should be slightly longer periods? How should that tie in with performance triggers and continuation votes and so on? What do you think? Is there a kind of gold standard here?
Well, I think there is, which I've already touched on, which is the discount control. That's where I think we will end up for successful trusts. The want to grow, because with the DCM, grow, issue stock. But if I just run through this, so first of all, the continuation vote. So the continuation vote was originally introduced back in the days when discounts were quite prevalent throughout the movement. And obviously that made it very difficult to issue new trusts. So the continuation vote was a wheeze which was concocted where stock would be issued, but with the assurance that in 5 or 7 years, whatever it was, there would be a continuation vote. And I well recall the idea being spoken, it was obviously never done. The Turkish Day big for Christmas, and no one's going to continue a trust stands at a discount. It turned out, for whatever reason, we don't have time to give ancient reasons here, but that was wholly untrue. We had trusts with absolutely dire performance and large discounts and almost no votes for discontinuation. Really, really remarkable. It's got a lot to do with games theory, as I say. Not for now, perhaps. But recently, it's changed. So recently, continuation votes are indeed, I would say, much more rationally responded to by investors and by people voting on behalf of investors. So that has improved a lot. And the only drawback is that probably, unless the discount has come in a lot, they will not be passed. So I believe that actually going straight to a DCM probably means that the assets under management will be greater on a time-weighted basis than running it for a year and having a continuation.
So the number of boards that have adopted discount control measures of various kinds has been growing, but it's still, I think, certainly not more than half anyway. I think it's less than half. But of course, that obviously does include the whole universe, that is, I'm talking about. Would your ideal utopia of everybody having a discount control mechanism where it's appropriate, are we going to get there?
Well, I think it is the rational place for them to end up, and therefore I hope they will. There are many, as you say, who adopted a discount target, usually 5%, sometimes just single digits. But the reason why a discount mechanism works, I think, much better is that if you only buy back at 5, say, to choose the narrowest of them, and you're issuing at 2, that 7% gap between the share price and the asset value is just too big to make it rational to buy at the 2. Your downside is not protected enough. So I think it will be quite difficult, except when a trust is in an area that really everyone is very enthusiastic for. It'll make it quite difficult to grow. Whereas if it's a DCM, that removes the threat, essentially, of the discount. And I do believe that for the people for whom investment trusts are designed, that's to say, retail investors who are just wish their savings to be invested efficiently, the discounts are a threat rather than an opportunity. Everyone in the city loves them because they think they're buying assets at good prices. But they are a threat because historically, in a bear market, we haven't had a proper bear market for a very long time. Discounts have widened. That's just been the history. So a rational person would be very wary of buying at 2% premium if he's worried that the board will allow the discount to go substantially wider, or discount to appear and go substantially wider in adverse circumstances.
Right. Well, we'll come back at the very end to the issue of whether or not maybe we are approaching such a moment where that might be put to the test. You are listening to our Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support. which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Let's just pick up on the HICL-TRIG merger that no longer is. I'm sure all listeners will know this is where capital gearing itself thrust itself into the limelight by coming out very promptly, indeed within a matter of hours, the deal originally being announced to combine those two alternatives trusts, to say that you were opposed to it. Since then, you've garnered quite a lot of support from other investors and the whole thing's been called off. Obviously, that is a feather in your cap, since you believe that the merger was a bad idea. What lessons have you taken from that? We know when you do object to something, you don't normally go public with something. But what do you think this episode tells us about both that merger and where we are in the cycle of investment trust generally?
Well, first of all, you're absolutely right. We would much rather talk to boards and chairmen privately, not through headlines. But this particular one had gone so far before we heard about it, and we thought that it was a very poor deal for HICL shareholders. And indeed, that view is reflected by every investment bank other than the one that was sponsoring it. So I think it was just a very poor deal in a number of respects. Second thing to say is that we are not opposed to consolidation. In fact, we're in favor of consolidation. But it has to be rational consolidation, and this was not. So we were very pleased, actually, that once we put our head above the parapet, how many shareholders got in touch for this, both retail and institution, to say that they did not wish to see proceed. And fortunately, the board took the view that even if they were able to get a narrow majority in favor of it, that would not be a satisfactory outcome. I heard it endorsed that view. So we're very pleased about it. We are keen for consolidation in a number of areas, but it has to be rational consolidation. This was not.
And that leaves, of course, an interesting set of questions behind it now that deal is not going ahead. It came across anyway, I think, as a deal which was the main beneficiary of it would be the manager of both trusts and, of course, the sponsor who would have made quite a lot of money out of fees for putting it together. They claim to have talked to a number of significant shareholders. They obviously didn't talk to you on both sides. But I guess if you're looking at it from TRIG's point of view, most people concluded that the deal was actually a good one for them, or at least a better one for them than it was for shareholders in HICL. And so, in a way, you can't blame them for actually going for it. But as a result of it, do you think that basically the renewables, effectively they're kind of on the block now, are they? Because that deal has only advertised the vulnerabilities that they have. The big discounts, the question marks about the NAVs, and not least the potential changes in the regime that governs the way that renewable energy trusts operate and are remunerated. So what does it tell us about where we are with the renewables, which have been very disappointing recently?
They have. Well, just to repeat my point, I don't believe it's proper to speak of the NAV of renewables with reference to the valuers' estimates that come out. I don't think they are all in play, actually, because many of them are trying to realize assets themselves and struggling to do so. So obviously, any potential acquirer will have noticed that. So there are trusts which are overtly liquidating and still trade at large discounts to the announced asset value. So I don't see a great deal of activity there. They are in a hard place. We've got a government that is proposing to change existing contracts in a rather alarming way. So that, I think, is very foolish of the government, in my view, because it is raising the cost of capital in that business. They've become unreliable partners. So it's strange because renewables were an area of emphasis when the government came in, and they seem to manage to destroy investor confidence.
Indeed. It's not been a good story, I think, even if you just judge it by its own merits or the advertised merits of what they're proposing to do. There does seem to be a lack of joined-up thinking around this policy and a number of others, I think I might venture to suggest. But when you talk about consolidation, should TRIG and other renewables trust, pick one name at random, those that are left anyway, Bluefield Solar or somebody, do you think that there is a case for consolidation within the renewables space?
Well, not much of one, because it's so difficult to say what the assets are worth. That's the long and the short of it. So it's very difficult to base a trade which will be fair to both parties. So in the renewables, I think that there is much less of a case. In the case of core infrastructure, there's a much stronger case because they plainly can sell assets at roughly the asset value that they declare. So there's a much stronger case for that.
So let's stick with the alternative just for a second. And I wonder, through the lens that you've been offering us perspective on the renewables and infrastructure and trust generally, how do you view the private equity sector at the moment, which is also trading on very big discounts? They have come in a little bit, and boards have made some moves towards announcing capital allocation policies, which at least go some way to address concerns that shareholders have expressed. But where do you think listed private equity sits at the moment?
Yes. So the point you raise about capital discipline is a very well-made one and has applications to core infrastructure and to private equity and a number of other areas. So the big problem for private equity is that we've had a very long time when very few realizations took place. You recall, Jonathan, that the coming year is always going to see a huge increase in those realizations, but we still wait. So it's not that there are not, but as a model, it's quite difficult to nail our commitments. So it's proved to be quite difficult to keep the overall exposure under control in some cases. So there is an issue whether that form of private equity, which falls into two parts, really. One is buying a boring company and levering it up a lot and hopefully improving the operations somewhat, but using high cash flow to pay down the debt. And that worked quite well for a long time, but of course, interest rates go up a lot. So I think the jury's still out. There are probably some that are working and some which are struggling. And venture capital, where there had been some very significant successes, actually, often at the expense of you and me. So if you go to the dentist or the vet, you'll find your bill is very much higher than it used to be because consolidation has meant that monopoly pricing or oligopoly pricing has been possible in areas where there are traditionally shortages. And that has worked out very well for the investors in those venture capital funds, not so well for you and me. And so how do they solve the problem of the large discounts that trade on, although they've actually come in a fair amount, in some cases in the last year, as people get more confident that there will ultimately be realizations at decent prices. And they certainly trade at bigger discounts than the secondary market in the underlying assets. So a worthwhile point to make. But the shareholders are still stuck with the problem that if realizations are made, the cash will be taken and reinvested into another private equity situation or private asset of some kind. And that'll be some years before that is realized. So the market continues to put very big discounts on. So the obvious thing, I think, for funds in that situation is to offer realization assurance. So you can just say, thank you very much, but from here on, I don't want my cash to be reinvested. When it's realized, I want to have it paid out. No one's under any illusions. It's going to take quite a long time before you get that money. But I think that is a fair way of distinguishing between people who have genuine enthusiasm for private assets, and there are plenty of those, and people who are very disillusioned by the discounts at which shares trade.
So just to wrap up on the alternatives, I mean, looking back, we know that a significant number of alternatives did come to the market after the global financial crisis because they were a way for people to access yields that were no longer available, or at least were no longer being generated by support from banks and so on. Private equity and commercial property have been around for a long time. They predated the global financial crisis. But commercial property investment trusts, a lot of them have either disappeared, the big ones have disappeared, or they've gone back to being a REIT or merged with a REIT or whatever, leaving the investment trust sector. So do you think that in 5 years' time we'll look back and we'll say, well, what was this whole alternatives bonanza all about?
No, I hope not, because where the underlying assets have adjusted and balance sheets have adjusted to the new level of interest rate that now prevails and we think will prevail for a long time. The zero interest rate environment was one which responded to a particular set of circumstances and will not be repeated other than at the very short end in a real crisis. So if we get a real crisis, I suppose we might go back to QE, that sort of thing. But I don't think that will be helpful to the rating of alternative investment trusts. But when they have adapted, and the balance sheets have been a particular feature, that the borrowing has been much too high for this new environment. It's taken quite a long time to sort it out, and some have not yet. So when we talk about capital discipline, we are always keen in the first place to see debt paid down to moderate levels, because we don't think debt adds a lot to the return, these interest rates. But only then buying back stock to realize the opportunities provided by the discount.
In other words, we've heard some people talk bleakly about investment trusts facing an existential crisis. You're not one of those who share that view, I'm getting the impression. But it is the case, surely, that the investment trust as a community, as you referred to them before, they do need to be able to go out there and to sell the merits of investment trusts and to demonstrate that some of the errors and omissions of the past will not be repeated. Would that be your kind of prescription for the future?
Well, yes, but there are some other reasons. So we've had a very unfavorable background to investment trusts for some time here. So first of all, you've done much better to buy an ETF on the S&P 500. And it's been really tough to match that because of the concentration. And if you have, we think that's going to be very different going forward. So I would have substantial bet that the assets of investment trusts will outperform the S&P 500 in the next 5 years. Well, the other way around, as it has been so far, we've had huge selling of UK assets generally. That has obviously put significant downward pressure on all of them, but certainly including investment trusts. And finally, the regulatory environment has drained liquidity from all small companies in the UK. And that certainly includes quite a lot of investment trusts. And so we are today in a situation where people argue about exactly how much, but probably somewhere around 700 million pounds market cap is about as low as you can get to be a viable trust, unless you have a DCM. So a DCM offers unlimited liquidity, but that overcomes the problem of the small size. But without that, there are a lot of trusts which are too small. They need to take action, either consolidation or adopting a DCM and growing, or frankly, offering tenders to allow people to get out. But that's a way of just shrinking trusts to nothing. So the tenders are just worth spending a second on. So the tender that you can withdraw 25%, typically realize 25% of your capital in a year's time or 2 years' time, basically offers the same route as a continuation route. So it doesn't solve the size problem. Obviously, it's exactly the opposite. And the conditional tender, so the conditional tenders tend to be rather further out, often 5 years away. And they're conditional on the assets outperforming the relevant index. All I can say is that, as a matter of observation, they have no impact at all on the level of discount in the short term. It's only when you get close to that date, particularly if you're underperforming, so it looks like you get the tender, that arbitrageurs start to play a role. And they're not the people you want anyway, and this is for long-term investors. So I don't think that's a great route. But as I say, you have to remember that investment trusts have outperformed their open-ended funds persistently over a very long period. And it'd be really sad if they don't thrive. And I think they can, but with a proper structure.
I think my point is just it's a hard sell, particularly if you're trying to sell to private investors rather than to professional investors, where to sell something which has had relatively poor performance, has had a lot of volatility in the share prices because of the discounts and everything else, and is deemed to be slightly more complicated than open-ended funds to understand, has other factors like gearings and so on. I mean, it's one thing to sell it as a sort of contrarian great idea at the moment, which you may well believe, and I would certainly believe, but it's another thing to actually sort of make it happen in the real world. So there is a big kind of marketing and sales challenge, is there not, for those that can survive the current process?
They absolutely do. So that underperformance against the world index has to change. If it continues, then that really is a really difficult hurdle to get over. And the volatility of discount has to change as well, in my view. And the liquidity has to change. So there has to be a great deal more liquidity provided. And frankly, we need also UK investors to want to buy UK assets rather than flee from them, as they have over the last decade or so. It's been extraordinary levels of sales. So it's not going to be easy, but I don't think it's cyclical. I think we can get to a bigger investment trust movement than we have now, and one with less controversy over discounts.
Well, let's hope so. The other risk out there, I guess, which is one you've alluded to already, is that there is some sort of market crisis, a severe bear market, shall we say. We know that the current global macro environment is troublesome. The US economy is booming on the back of an AI capital spend, but otherwise other regions of the world are not growing as fast as they were, or indeed as we were used to before the global financial crisis. You quoted, I think, Jamie Dimon, the CEO of JP Morgan, expressing some concerns about what the bond market will do, and at some point the bond market might crack because of this continued indebtedness of many developed country governments. So if you put that together, you would think, and I think you would share this view, that there is a serious risk of some kind of market crisis at some point quite soon, because valuations on equities are high, at least in certain areas, and the bond market is under pressure. So how would you characterize your thoughts on that particular issue?
Well, the valuations on the S&P 500 are very high, so high that the expected return over the last 10 years, if history is any guide, are essentially zero. And I would expect quite a major fall. And actually, just this week, we had a speech from the BIS making very much the same points, that with a zeitgeist where nobody cares about debt, so huge deficits, quite inappropriate deficits being run all over the world, not just the UK, the US, certainly includes France, and that there will be a bond crisis. But may I quote Buffett?
Of course you can. Always welcome to quote the great man, yes.
Because it very much reflects our own view. So it's actually from just before the great financial crisis in October 2008, but I think this reads very well now. So he said, I mean, you know, at midnight, everything is going to turn to pumpkins and mice, right? But if the evening goes along, I mean, you know, the guys are better all the time, the music sounds better, it's more and more fun. You think, why the hell should I leave at 11:45? I'll leave at 2 minutes to 12. But the trouble is, there are no clocks on the wall, and everybody thinks they're going to leave at 2 minutes to 12. So our answer to that is, if it's 11:45, or even close to it, then the answer is to already ordered your coach and hope you might get home before it changes. So we are very risk averse at the moment, and we try and own assets that will do well actually go up in a crisis, as we succeeded in doing in the great financial crisis in 2008, 9, 10, and in the dot-com bubble in 2000. And just to remind people, because I think when people talk about market correction, they have in mind probably not a specific number, but not very big. But just to remind you that in the dot-com bubble, the S&P 500, not the Nasdaq, S&P 500, went down by 49%. In the global financial crisis, the drawdown was 57%. And faced with that, I think individual shareholders should just ask themselves, how much of my money can I risk facing those odds? And if you're very young, maybe it's still quite a lot, but probably for most of us, the idea of losing half our money is extraordinarily unattractive. So we hope the Capital Gearing Trust offers a safe haven to see us through those storms.
Well, it has done in the past, you can certainly say that. I guess the only thing to say, which people might say, is, well, it's all very well, but what are we going to put our money into if we're not putting it into richly valued equities of one kind or another? There is a sort of paradox, isn't there, about, I mean, you obviously have been making the case for index-linked gilts and TIPS in America. They're offering positive yields. Good Lord, who ever thought we'd see that again after the global financial crisis? And here they are offering positive yields. But, you know, it's the same thing. Is the answer to the problems of governments to lend more money to governments? I don't know whether that's a good idea or not.
Well, we spent a lot of time discussing this, but I think the answer is that the monetary policy has to be very loose in order to preserve some semblance of natural stability. But against the background that we currently enjoy, that is very inflationary. So as well as needing protection against the fall of the nominal price of shares, you need protection against the fall of the value of cash as well. So that's the basis in which we have a lot of index link.
My final point here, Peter, then is this. I did say I would ask you this question, which is, that's the rationale for Capital Gearing Trust. But in terms of the likelihood of the world sort of navigating its way through its current difficulties, including that huge government debt pile in many countries, it's always said one of the key figures in that is the chairman of the Federal Reserve. We're approaching an interesting juncture where be careful what I say here, but President Trump is getting very close to picking somebody. And the Treasury Secretary, Scott Bessent, who's a former hedge fund manager, who knows quite a lot about finance, has been looking at candidates. The current name that's sort of top of the list is a man called Kevin Hassett, I believe, or at least he's been named by some media as being the front runner. What are the likelihood we're going to get another Paul Volcker as the next chairman of the Federal Reserve, or are we going to go back to the horrors of the late 1960s and early 70s when Federal Reserve chairmen didn't cover themselves in glory?
Okay, so that's an easy question to answer. The chances of another Paul Volcker are precisely zero. But the interesting thing is that the market really likes the idea of a chairman who would lower short rates inappropriately, i.e. when a conventional central banker would not cut them. And the market thinks that's great in the short term. The bond market essentially relies on confidence. So the confidence that you need to buy a long bond in any market is that, first of all, the country of credit will pay you what they have contracted to. And secondly, in the case of nominal bonds, that they will pay you in a currency which is not to be printed and devalued and debased while you own it. So the concern is that if you have inappropriately dovish monetary policy, and that tests the confidence of bondholders. So we will see how that plays out. But as I say, in the short term, encouraging liquidity and suggesting that the short interest rates will be manipulated downwards has proved only to be encouraging to asset prices in both bond and equity markets.
Yes. So there's been quite a well-received book, which was published about 1929 by the American journalist Andrew Ross Sorkin. And of course, the time just before midnight is often very exciting and very profitable in the short term.
Indeed. So we do not underestimate the possibility that the last dance is the most exciting one, and that we will be missing out on some quite interesting games. But as I say, if you look at the work done by, for instance, Robert Merton, who's the Nobel Prize-winning economist and sadly also featured in long-term credit, but leaving that on one side. But he did good work to show if you had a 60-40 portfolio, which you vary those weightings according to the risk and reward in each of them, you could significantly outperform over time both asset classes. And that is the theoretical background to exactly what we're trying to do.
Well, on that note, I think we should draw it to a close. We're just, in other words, saying we're at a very interesting juncture in financial markets, and indeed, you could say it may turn out to be quite an important juncture in terms of the history of our developed world. You might broaden it that much. But anyway, thank you very much, Peter, for enlightening us, as you always do, on this podcast. And that was Peter Spiller, the manager of Capital Gearing Trust, looking back and looking forward with all his many years of experience.
Thank you, Austin.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.